Hey everybody, it's Mortgage Mike here from Coastal Mortgage Solutions. And how are all my mortgage maniacs doing out there? I want to share something with you guys. Let's do a little series on kind of a get behind the scenes of what mortgage underwriters look at when they're looking to pre-approve loans and get the loan to a closing table. So let's start out with today on what underwriters look at. We're going to call it it's the 3 C's. The first one is capacity. The second is credit. And the third is collateral. So let's go through each one. Capacity. So capacity is really a borrower's ability to be able to pay off all their debt. Okay, so and it's not just the mortgage. So they want to see, like, can a borrower pay the mortgage plus any other debt they have? And that can include things like consumer debt, car loans, whatever else is out there. Okay, so we typically use a ratio called DTI, or debt to income ratio, that basically shows, how much debt you have versus how much income you have. And there's a percentage that we use to basically measure if that borrower can actually pay that debt on a monthly basis. So the second here is credit. Now, when we're looking at credit, we're looking at both the credit score and also credit history. So the two go hand in hand, because there can be credit history if there are lates, like 30-day, 60 or 90-day lates. Sometimes that can have an impact. But I think we can go into something a little more intense on credit down the line. But that is number 2, credit, okay? So number 3 is collateral. Collateral is basically the assets that a borrower pledges to secure a loan. So what does that mean exactly? It just means basically that you have the assets on hand, the cash on hand, and some type of account to be able to close that loan. You may need to secure that loan with some additional funds for closing. All right, so that's our 3 C's. Our 3 C's here, 3 C's, is capacity, credit, and collateral. And this is basically what underwriters use as a journal format, kind of as a template to kind of check to see if a borrower is able to secure a loan.